starting. My stream should be live any moment now. 9 o'clock. 9 p.m. Here we go. 1 second. Yeah, turn my phone off, so I'm good to go. And we are ready to go. It's 9 o'clock. Today's Thursday, January 12th, 2017. Now, if you guys have been following me, you know that we do options on Thursday night. Thursday night's a great night to do options. Why? Because we don't do options on Tuesday night. So we're here Tuesday, we're here Thursday, 9 o'clock Eastern Standard Time every week. And what do? We talk about investing in dividend stocks, specifically investing for monthly income, because we want to get a monthly check or a weekly check. Either way, I want to get paid for what I do or for investing my money. So, as we said earlier, 9 o'clock, Thursday, January 12th, 2017. So let's jump right on in and see what we are looking at. Okay, this is... And I really got to open up my other trading account because this one doesn't have options to it. This one is just dividend capturing. We got 5 positions so far this year. Caterpillar. Oh, wait a second. This is my option trading one. All right, great. So as you can see, if you're looking, we got overall year-to-date profit, $6,398. That's about $6,400. And we are only, there was no trading on the second, on Monday, so we're only 1, 2, 3, 4, 5, 6, 7, 8 days. Today's the 8th day of trading. Now, almost all of these positions have weekly options on, so let's check it out. Caterpillar. View trade. Okay, that was basically a covered call. What we did with this one, let's bring up Caterpillar so you can see where we are. CAT. Caterpillar. Now we jumped into Caterpillar on the 3rd, I believe. Look at that. 1, 2, 3, 4, 5, 6 down days in a row. Wow. Okay, so why did we get into Caterpillar? I'll tell you why we got into Caterpillar. Let's bring up the software so I can tell you exactly why we got into Caterpillar. Not that. Now, Caterpillar has a dividend coming up very shortly. So what we wanted to do is we wanted to take advantage of it. Now, let's get rid of the blue line by clicking on the average, and that tells you what the average, the stock has, how the stock has performed over the last 9 or 10 years. Okay, the red dots represent the EX date. Now, the EX date for Caterpillar is coming up in the next week or so. Okay, so we like to get in 10 days ahead of time. So what this software basically gives 1 year on top of another on top of another. So if I highlight a year, it's basically going to tell me how the stock performed in that year. 2007, that's how it performed. 2006, this is what it did. 2012, this is what it did. Okay, 2016, that's what it did. So all of this information is put on top of one another. It's 1 year on top of another, and then we get an average of how well the stock moved during that period. So it gives us an idea of the possibilities that could be coming up. Now, it's not guaranteed. It's just a possibility because that's what happened in the past. Okay, so this represents the EX dividend date. Okay, and if you go to my left, way over here, that represents how many days prior to the EX date. 9 days prior to the EX date. This is what this thing looks like. It looks like it's going to drop down a little bit. Go down a couple of days. Look, what's that? That's what, 9 days in. Then all of a sudden, she just starts moving up. This is an average. So if we want an exact of what it's going to do, there's no way we can get that. An average just gives us 1 year on top of another. So it kind of averages out. All right. So we wanted to get in Caterpillar has a 3.3% yield, which is good. It closed at 95.65 and had a high of 97 and a low of 56, with about a 3.1 million shares being traded. So everything looks good on this piece of software. Let's jump over to the next piece and put in Caterpillar. And hit go, and let's see what that says. All right, for some strange reason, Caterpillar didn't pay dividends on 2013. Why? I don't know. It took 11 days for it to hit the target in 2011. It didn't hit the target in 2015. In 2016, it took 41 days. So why do I want this one? Well, this is only part of the information. What is clincher would be the 10-year chart from what we're going over here to Yahoo Finance. Now, the 10-year chart for Caterpillar basically shows us this thing's been going, well, you could say sideways, because it has its ups and it has its downs, ups, downs, up, down. Basically what a stock does. But for the main point, she's been trading right around the same range. So 10 years ago, it was at $64. Okay. Yeah, she hit a high way up here at 115, which is almost 100% increase. But then she dropped way back down here to 73. And right now, she's at 93. So 10 years ago, it was in the 60s. Now it's in the 90s. That's a 50% increase in the last 10 years. Okay, so is the next 10 years going to look the same? I don't know. Could it? That would be nice. At least the stock is not on a downtrend. It's going sideways. Sideways is good for a dividend stock because we want to get in, we want to collect a dividend, get back out again. Because you can see it in the 10 years. Up, down, up, down, up, down, up, down. It goes over and over again for the whole 10-year period. Look at where the dividend is. Okay, you buy the stock just before the dividend date. You collect, collect a profit, and you just get back out again. You collect a small amount, and you just keep the ball rolling. Okay, so that was Caterpillar, and that's one reason why we like Caterpillar. So what happened back on the 4th? Okay, this is when we bought it because the stock market wasn't open on the 1st. So we didn't buy it on the 3rd. We did end up getting it on the 4th. I believe we got it on the 4th. Oh, wait a minute. What I did was I sold a put debit. No, a put credit spread. Well, put credit spread was I wanted to own the stock at 93. Now, the stock wasn't quite at 93, or was just above 93. So what I did is I sold the credit put spread last week, and I collected like a 30% premium. Okay, so I put it up a certain amount of money, and they gave me a 30% return for like 3 or 4 days. So I couldn't pass it up, so I did that. Sold 10 contracts on that. And what happened? First thing Monday morning, look at this. This thing, oh well. Friday, she ended up closing below 93, so I had to end up buying them at 93. I believe that's right. Let's view trades. Yeah, so I ended up buying them on the 7th, which was Saturday because the options expired. Okay, so I sold the option on Tuesday. Okay, I collected a 30% premium from the amount of money I had invested. Friday, the stock closes below on 93. So Saturday, I end up being the proud owner of 1,000 shares of Caterpillar. So what happens first thing Monday? First thing Monday, I went and I sold 10 contracts for someone to buy it from me at 93. Now, does that make sense to any of you? You buy it at 93 and you sell it at 93. Where am I making my money? Well, I'm going to tell you. I made my money from selling the put credit spread last week. I made a 30% return on the money I had invested last week. So this week I have 1,000 shares, and now I turned around and I sold 10 contracts at 80 cents a share. Okay, so I collected that $800. Okay, 1,000 contracts, 80 cents a share. That's $1,000. Well, $800 I collected. And what happens at the end of this week? Tomorrow, being Friday, if this stock stays above 93, Saturday morning, okay, tomorrow, the 13th, if the stock stays above 93, then Saturday morning, someone else will buy it from me at 93. They'll be happy to buy it at 93 because right now, as you can see, it's at 93.99. Okay? So Saturday, I won't own it anymore. And then come Monday morning, I'll have that little chunk of money to buy something else. Or to sell another credit spread. I love credit spreads because when you couple the credit spreads along with the dividends, it gives you an idea that the stock is going to move because the dividend's coming up. Or it's going to stay the same. So a put credit spread is going to allow you, I'm going to do a few of them before the night's over, but a put credit spread allows you to make money if the stock goes up, stays the same, or goes down just a little bit. And that's an awesome way of looking at things because number one, we're looking for it to go up. Number two, we're looking to buy it. Number three, if we do buy it, we can collect a dividend and collect a little bit of money for the premium. Okay, so let's just take a quick look. Now that's Caterpillar. We did that one. And today we did Clorox. Let's take a look at the trade for Clorox. Clorox is basically the same thing. Okay? We ended up buying 400 shares of Clorox this morning, and we sold. We bought some call debit spreads for Clorox. Let's see, CLX. Okay, CLX is at 119. Okay, so we're looking to get rid of. So I have two positions on Clorox. I have 400 shares that I'm looking to capture the dividend equivalents, which is only 80 cents. I'm looking to capture that, hopefully within the 10 days before the EX date comes. And I'm also looking to for this thing to close above 120. Okay, because you see right here, I bought the 115s and I sold the 120s. Okay, so that is a call debit spread. Okay, so 115 is way down here and 120 is way up here. So my bet by the end of next week, that's the 20th, see that? It says 120 January 17, 115 calls. That's for next Friday. Okay, so hopefully by next Friday, Clorox, who has their dividend coming up within the next 10 days, is going to be paying out a dividend. Right now, they're at 119.09. Can they go up 91 cents? Sure they can. Why not? It's a $100 stock. You know, that's only what? A 1% move? Okay, so that's Clorox and Caterpillar. All right. GD, let's take a look at what that, before that, let's open up GD. GD right here. Okay, GD's at 176. Now that's another election baby. Now when I say election baby, there's certain times of the year you're going to notice the stocks move a certain time. And if you look at the bigger chart, it'll give you pivotal points like the dot-com bust back in 2000, the real estate market meltdown in 08. Well, we have another one called the presidential election. Okay, November 8th, right in that time between 7th, 8th, 9th, 10th, that period right here. Okay, why did you can look at stocks and it's like almost a 50% split, a 50-50 split. Half of them go up, half of them go down. This is one that on the election, Donald Trump gets elected, very next day the stock moves up. That's almost triple volume. See these little blue squares down here? That represents volume. Here's your average volume, like that. There. Look at this. On the 7th and the 8th, the volume's way down here. The very next day, Trump's elected on the 8th. Okay, very next day, triple volume. Why? Why is it triple volume? I don't know. And then nothing but up. You get profit taking here. Okay, look. Okay, Trump gets elected. Look at all that profit. She closed at 149. Okay, she opens at 150. She opens at 151, and from there, she makes a high of 171. That's a $20 move in a week. That's crazy. A $20 move in a week. And then she goes sideways for a while. She got a $20 move, people taking profits, but hey, it still goes up again. Look at this. 1, 2, 3, 4, 5, 6 days in a row. She goes up. Okay, so that's GD. Let's see what our play was for GD. Okay, now let's view the trade for GD. All right, you bought GD on the 4th, and what did we buy? We bought the 165, 170 calls. Okay, so we're looking for the spread between 165, 170. Right now, she's at 176, so we're in the money. So we made money on that one. Okay, I don't know how much we made at this moment in time, but hey, money's money. Anyway, so GD, we made money on that one. Lowe's, that's the Dividend King, so you can't go wrong with the Dividend King. Okay, so this one, going a little bit of a downtrend, but then again, end of December, beginning of January is not the greatest time of the year for buying, household, what do you call it, renovation stuff. Who wants to buy 2x4s, plywood, roofing stuff in December and January? That's probably why the stock went down. But anyway, she's going down. She's got a dividend coming up in the next 2 weeks. And what did we end up buying? We ended up buying... okay, we did a put credit spread. So we're assuming it's going to go up. All right, so we bought the 70/50s, all right, $70.50, and we sold the 71s. So we're basically saying that this thing, we're betting that this is going to stay above 71. And if it stays above 71, we get all that profit, okay? And it's not a heck of a lot, but it's easy money. Okay, and right now she's at 71.58. So tomorrow, she expires tomorrow. So is it going to stay above 71? Good bet. I don't know. And if she does, guess what? I'm jumping back in this one first thing Monday. Do you know why? Because Lowe's is a good company and it has weekly options. So every week, you get more and more trades I can do. And I love dividend stocks that coming up with a dividend play and have weekly options. It allows me to do 3 plays on that stock before the EX date. And I like doing that because basically free money, especially when the software is right. I love it when the software is right. And it's been right so far because we're almost at $6,400 in the second week. That's crazy. Most people didn't make 6% on their money last year. And I made 6% in the first 2 weeks. All right, so Lowe's, that's what we're looking at. A put credit spread. Okay, so we actually got paid to do this trade. So that's a good one. And hopefully, look at it this way. We collected money on it, which is, I believe, we collected like 30 or 40% on this one yesterday because it was a good trade yesterday. And then, if we get stuck with it, if it drops below 71, we're going to end up buying 1,000 shares of Lowe's first thing Saturday morning, and then first thing Monday morning, we're going to be selling 10 contracts, buying it for selling at the exact same price we paid for it, which covered call, credit spreads, gotta love them. Does nothing but make your income go up, 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 up. And it's safe because if we get stuck with Lowe's, holding on to Lowe's has got like a 3% yield. So if I just buy it and hold it, I'm collecting 3%. Every 90 days, I get a check from Lowe's, okay, or from the corporation for being an investor. All right, or owning the shares, 1,000 shares. What is it? I really don't know at this time. Well, let's take a quick look, find out what Lowe's is. That's the 12th, 24th. Here it is right there, 35 cents. Come on up. There we go. All right, so Lowe's has a 35-cent dividend. Okay, so 1,000 shares is $350. Granted, it's not a lot of money, but getting $350 every 90 days, I can deal with it. Where were we? Right here. All right, so that's Lowe's. And Vail, we got Vail the 13.17 at the 8. And I believe, oh, this is a great one. We got 40% on this one last week. Okay, we ended up buying Vail at 8. Okay. Let's pull up Vail right now. V-A-L-E. Oops. V-A-L-E. There we go. Vail. Okay, now. This is what Vail looks like last week. Why did it move up? I honestly can't tell you that one. All right, we got Vail on the 3rd. All right, we sold the credit put spread, and we ended up buying 1,000 shares of Vail come Saturday morning at $7.50. Oh, I'm at 8. It was at $8, I believe. Yeah, we said the $7.50, $8 spread. We ended up buying it $8, and what we ended up doing is turn around and reselling it at $8, and look what happened. She went from opening up at 8:31 on Monday to 9:55 today. It's a high of 9:55 today. Now, had I not sold the 10 contracts, then I could have sold it today at 9:55. But it doesn't always work that way. Okay, I ended up selling the 10 contracts at 40 cents, which is $400. It's not bad. Oh, wait a second, look at that. I ended up buying Vail at 7.50, and I sold the 8s for 40 cents. So I'm profiting the 40 cents per share, plus I bought it at $7.50, so I'm selling it at 8. That's a 90-cent return on each one for less than a week. That's pretty good. Okay, so that's what I've done in the past couple of days. Let's see what's coming up, because we're at 9:23. We're going to see what's coming up in the next couple of days. Run through some scenarios, maybe do a trade or two. And then we'll answer some questions. Let's go to the Market Watch. Today being the 12th, then we have the 13th, which is tomorrow. So what we're looking at the 26th and the 27th. Okay, so the 26th, we have CAG, CLC, and LW. And then on the 27th, we have all these guys. Oh, look at that. Oracle. Stag. They do real estate, I believe. And I honestly couldn't tell you any more of these guys. VRTS. Who are they? VRTS. Vitris Investment Partners. Student Transportation. Stag Industries. Tanger Factory Outlet Centers. Scholastic Corporation. Saratoga Investment Corporation. Prospect Capital Corporation. Plains GP Holdings. I haven't even heard of them. Plains All-American Pipeline. Orchid Island Capital. Genesis Energy. Great Elm Capital Corporation. Eaton Vance Corporation. And who's EPD? EPD is Enterprise Products Partners. Chatham Lodging Trust. Never heard of them. And Apogee Enterprises. Okay, who are these three? LW would be Lamb Weston Holdings, Clarcor Incorporated, and Congra Brands. I never even heard of hardly any of these guys. But you know what? I really don't care. What I do care about is how do they look on the charts. So let's quickly run through a couple. I'm just going to go through these three and maybe go through some trading scenarios. All right, so CAG, reset. CAG, CLC, and what was that third one? The third one was LW. LW. All right, hit go. So if you guys are members of the 10-minute trader, you have access to these. So, LW, is that right? That can't be right. LW, it's right. It's paying a dividend of 18 cents. However, they have no history whatsoever. LW, not available. All right, so we have CLC and CAG. Okay, they're both averaging around a day and a half. Well, this is averaging a day. All right. Let's look at the numbers. Let's get rid of this one, so get rid of some confusion. First off, this one closed at 82.53, a high of 83. All right, kind of high. It's very, very close to the high of the year. That doesn't make me a happy camper. The low is 44.38. It has a one-year target of 83. Okay, so they're not really projecting to go any higher than it already went. I'm not sure I'm liking that idea. 25% dividend, I can deal with that. It's a 1.21% yield. I don't like that because you can get that at a bank, so why put your money at risk? And only 500,000 shares traded. So let's go. Who was that? That was CLC, right? All right, let's take a look at what CLC looks like. CLC. All right, I'm going to tell you right off the bat, I'm not going to do this one. Now, this is why. The high of the year is right about now, 82. The low of the year is way back last January. A nice slight uptrend all year long, right till we get to December, first week in December. What happens? November 30th, she closes at 69.51. The very next day, she opens up at 81.74. Why? What is the reason for the jump? And then look at the volume. That is huge volume spike. Okay, that's just crazy. And what happens when you have a volume spike like that and an uptrend like that? The stock's going to go down eventually. It's going to eventually fill the gap. Gaps get filled, just the way it is. Okay, so she comes here, she closes on that big, huge day at 81.70, and then she just goes sideways, and that's what she's doing. Okay? She's very close to the high of the year, and that huge gap up, sorry, I'm not buying it. I'm not going to go with that one. So, and she missed dividends in 2014 and 2015. All right. Sorry, no thanks. So CAG has an average of a day and a half. Okay, so we get in, get out, we get our whopping 20 cents. All right, granted it's not a huge amount, but if we held on to it, it's 2%. Okay, so every 90 days we get a nice little check for 19 cents a share, however many shares you buy. You buy 1,000 shares, you get, $190. You buy 10,000 shares, you get, $1,900. Whatever. Okay, but anyway, I just want to get in, want to get my check, and I want to get out. I can deal with $190 for one day. It takes me less than 5-10 minutes to do the trade. So $190 for less than 5 minutes, I'll do it. Okay, so that was CAG. Let's take a look at the chart from CAG, the 10 years, and see what they look like for the last 10 years, and then see if it's a good deal or not. If not, we'll just jump on for the next day and see what's up. Okay, this doesn't look that bad. She closed at 38.51. 10 years ago, she was at 25. So 25 to 38 is about a $10, $12 move, which is about a 50% move. Okay, I can deal with a 50% in a 10-year period. It's not bad. She gets her ups, she gets her downs. 08, everything's down in 08 and 09, so no big deal there. And from the low of February of 09, it's nothing but a nice trend upwards to where she is now. Okay, so I like that. So let's jump on one more piece of software. Take a look at that. CAG, not this one. We'll look at the next one. All right, slide on up. Put in CAG and see what it looks like on that chart. Okay, get rid of that. Let's go to the average. Okay, so coming into the dividend, she has a tendency to drop down a little bit. She goes down for about the first 2 weeks, and then from there, sideways and upwards. Okay, so it looks like we're going to make our dividend play. All right, get in, get your profit, get out. But usually does it in the first 2 days. And that's what I'm looking for. Get in, get out, and move on. So let's actually bring in CAG. Now I can deal with CAG. It's a nice looking chart. Not the greatest in the world, but just take a look. Okay, she had a high of almost 40, 39.85 back in the end of December. The low of the year is actually in January of last year, the third week in January. But you see from January to now, it's a nice steady uptrend. Granted, I'd like to know what this downward movement was right here. I don't need to know, but kind of curious. But from January of last year till December of last year, it's a nice steady uptrend. Now the last 30 days, kind of curious. Why does she have 1, 2, 3, 4, 5, 6, 7, 8 down days in a row? All right. She goes up, a little bit of profit taken, up, a little bit of profit taken, up, and she goes sideways, and all of a sudden, the beginning of the year, she's going down. Why? What's with CAG? Why is it going down? That I would like to know. However, she seems to have bottomed out right here on this trend movement at 38.23, somewhere around here. And then she's trying to make it up. See, the market maker on these days is forcing the price down. All right, the second day of the year, he opened up higher from the close of the previous day. Okay, she closed on the first day of the year at 39.71. All right, she closed at 39.76, and the next day he tries to open it up higher, 39.80, but nobody's buying, so this thing starts dropping down. The next day he tries to go higher again. See, she closed at 39.09. The next day he tries to open up higher at 39.44. Nobody's buying. Okay, nobody's biting. Nobody's taking the bait. Next day he opens lower. So she closed at 38.95. Next day he opens at 38.83, lower. Same thing the next day. She closes at 38.74. Next day he opens it at 38.61, and he does it again. He does it three days in a row, and then the fourth day he tries to force the price up. So what does he do? He opens up a little bit higher at 38.66, but she closed at 38.27. It's kind of close. She closed at 38.64. Very tight. It's only like a 2-cent difference. And then today, the 12th, she opened up at 38.53. She closed at 38.51. That's very close to being a doji. So what's happening here? What it looks like is that it's finding its bottom here. Now remember, she's got she's got the dividend coming up, and historically speaking, the dividend pushes the stocks up. Well, this one in particular. And so I'm going to jump in. I'm actually going to do a trade on this one right now. So this is where she is now, and let's see what we're looking at for tomorrow. CAG. All right, CAG has weekly options. So this is going to be for next week. Where do I see this thing going in the next week? All right now she's at 38.51. I think credit doesn't look very good. 38. Do I want to buy this at 38? Yeah, I'll buy this at 38. Why not? How much of a credit am I getting now? How much is it costing me? All right, $60 off of 900. Nah, that's not enough. Sorry. Quick, right to the point. I would rather do 38.39, 125. What is this one? That's dull. It's not looking good. 32. Okay, so why am I looking at this one? It's 8 days. Do I really want to do 8 days? I don't know. All right, so what are we looking at? We're looking at a call debit spread at 38.39. 38's here, 39's up here. Okay, so if we buy this at 70 cents, the thing's going to have to hit 38.71 just to break even. Right now she's at 38.51, so that's only 19 cents off. Okay, so for every dollar the stock moves up, the option is going to move up 20 cents or 21 cents. So if she hit, what did I just do? If she goes up a buck to 39.51, which is up to here, which is possible because it's still not breaking the plane of the resistance, right up here. But can it make a dollar move? I don't know. So I tell you what, I'm going to pass on this one because I don't really see it. And she has an awfully big spread. It's a 40 cent to a 70 cent. So if I buy it at wait a second, it's at 32. Yeah, I hate after hours trading when you're doing options because the spread is so wide, you really can't tell what you're getting in at. So if I put this in at 32 and I want to turn around and resell it, I'm going to have to sell it for at least 42, 52, 62, somewhere in that area in order to make enough money to my profit. That's when I do it here. Look, it's cost me $30 just to do the trade. So it's $350 to do this trade. The maximum I can make is $600. So I can almost double my money. But when I turn around and sell it, they take another $30. It takes another $30 off of it, so that brings me down to $650. So that means I'll only make $300, which is almost 100% profit. But the stock have to move above 39. It's at 38.51. And have to go above 39. That's only a 49-cent move. Could it make a 49-cent move? That's a good question. Let's take a quick look. All right. This is saying no. There it is right there. Goes sideways a little bit, and then she drops, going into the dividend play. So there's a high probability that if it does what it did last year and the year before and the year before, that it's not going to hit the target that I want. So I'm going to pass on that one. And let's open this back up again. So we're going to say no. Let's go back to the watch list and go to the next list. Now this is quite a bit to look at. So let's just even it out by the highest one. GEL. Let's take a look at GEL. GEL. Okay, GEL has a 71-cent dividend. She had a high this year at 40 and a low this year at right around 1975. Last 90 days, nice little upswing. I like that. But the last week, a little bit of a downtrend. She's coming in to a dividend. So let's take a look what the software says and what the dividend play looks like. That was GEL, so let's put GEL in here. GEL, it's got its dividend 13 on the 27th. Okay, plot the dividend. Here we go. Slide this down. Okay, so looking at an average of 6 days. That's not bad. 2 days, 2 days, 2 days. Bad. Look at this, 2016, 46. Why did it take 46 days? Oh, okay. That kind of makes sense. But she still went up. I like that. Nice movement. All right, so let's go back to the average. The yield. Oh, I like the yield. Check that out. 7.61%. That's nice. The volume's only like 300,000. So let's take a look at GEL on here. Let's hit reset and hit GEL. Hit go. All right. I like that. And it's got a closed at 35.45, high 30. The high is 40.90. I like that. The low's okay. The 1 year target 40. I like that. The dividend 70 cents yields that. And the average 30-day volume is 400,000. Just quickly take a look at what the chart looks like and see what she's done for the past 10 years. And I'm crossing my fingers here because this could be a good one. Okay, not bad. She's at 36. She had a high in 2014 of 57. Okay, so 10 years ago, this company was at 1965. Today, through its ups and downs of the year, she's at 35. So 19 to 35, that's a $16 move. That's almost a 100% move. I like that. All right, so the 10-year chart looks good. There's an awful lot of dividends paid in this little spread here. I don't know why they did that. Maybe they had some extra payments. So anyway, so we got the 2, 3 charts, 3 pieces of software saying good. So let's take a look at what she looks like. GEL. Enter. All right, GEL doesn't have weekly options, but she does have monthly options. All right, so she's at 35.47. She just closed at 35.47. We can do a spread, 35. 15 credit. 120, 2,300. See, that's not a good spread. I'm making $120 off of 2,300. That's 20%, somewhere in that area. Okay, can I deal with the 20%? Nah, not with that much risk. The most I can make is 120 if I sell it off at $90. Nah, not really worth it. So let's check the spread. The 37 and a half. What's this one? All right, this one's not bad. No, it is. Because it's only $2.50 spread. And it's costing me $2.55 to buy it. So no, that's not a good one. This one here, she's 45 cents into the money, the 35 and a half. Or the 37 and a half, which means it has to go up $2.03 in order to be in the money. It's going to cost me 60 cents to do that. And the delta is at 42, which is almost a 75% increase for a dollar. It means every dollar the stock moves up, the dividend's going to... every dollar the stock moves up, the option price is going to go up by 42 cents. Okay? So I don't know, maybe we should do 10 contracts of this one. See what happens. Okay, let's do that. Okay, so 10 contracts. Confirm and send. So my break even is going to be 35. Just below, right around 36, my break even. So as long as the thing stays above 36, which is not that far away, I'll be making money on this one. All right, so it's 1:15. Let's see if we have any questions, and we can wrap this up rather quick. Live chat. Oh no. Anyway, it doesn't seem we have any questions, so I am going to be bugging out right about now. So hopefully, answers all your questions, do some little bit of trading. You guys have a great day, and we will see you the next time around. This is James from the 10-Minute Trader. You have a great day. Bye. Stop streaming. No.